There is some degree of confusion about precisely what a breakout is, and some of that is probably due to a reasonable amount of poor information out there that relates to it. Now, once you have a better understanding of what breakouts really are, you'll see just how useful that they can be. So the first point is to specify what a breakout isn't. They're not a move higher or lower beyond a swing that's currently in progress. They're not a move beyond a pivot point. They're not a move beyond a moving average. It's not a move beyond any artificially generated number. Now, that's not to say that you won't ever see any moves through these types of technical features exhibit breakout behavior, but often it'll be that they coincide with structural features when they do. Breaks from a structural aspect are where price moves through an area which has already been tested and previously moved away from. They're generally more significant when the move away from the tested area is clean and fast. Now, the reason for this is that it indicates a greater level of change when the break does happen, and really, this is what breakouts are all about. In reality, it's probably better to redefine the terminology we're using, as it may be this that causes the greatest level of confusion. A level can be taken out, and a market can undergo a behavioral change. It's really the latter that I see as what is typically defined as a breakout. A level being taken out might only mean a continuation of the same behavior. Of course, that's still relevant to a trader, but it hardly constitutes a breakout if the market is simply continuing to do what it's been doing already. However, if you think about a change in behavior, then you can see that the market is breaking away. Typically, this is when a market goes from some type of balanced movement to imbalance or a range to a trend. It can happen at a specific price level, or it can happen at a structural reference point such as a trend line, for example. The point I made earlier about a breakout not being a move beyond the high or low of the current swing in progress isn't strictly true. If you were to reduce the time frame, for example, look at the bars under a microscope, you may well see swings within those bars which are broken on a new high or low. But the goal isn't to try to capitalize on what the smaller time frames are doing. It's to ride the wave of the higher time frame. Now, the reason for this should be clear. It's because directional trading in a time frame that's higher than the one you execute in will carry the market in your time frame. The higher the time frame, the bigger the move. Think about that for a moment. The biggest players, such as banks and funds, have to look at a higher time frame. If they didn't, how would they be able to execute the sorts of volume that they do? They are looking to execute thousands of contracts. So to get in and out in the same area would be very difficult to do in such a short space of time. Recognizing where changes might occur in a higher time frame is therefore likely to be able to carry your trades if you manage them well. You have to consider what constitutes an actual change in behavior, as markets are elastic to a greater or lesser extent. In terms of a break at a specific price level, a market moving through the level does not automatically confirm this. This can signify a break, or an extension, or simply a breach. A break is the obvious one. Price moves beyond an area and continues in that direction. Often, but not always, a break is accompanied by an immediate retest close to where it broke out or the break price. When this retest holds, this is where losing positions are covered and new positions are initiated, propelling the market further in the direction of the break. An extension is where price clears the level by what would be considered a reasonable amount for the product and time frame you're tracking, only to reverse back and continue with the action that was defining it before the attempted break. The amount it needs to break can be estimated by doing some simple statistical work on the size of rotations for the instrument and time frames that you're looking at. A breach is similar to an extension in that the range does extend. However, price does not extend far enough to warrant the sort of behavior seen on a retest of the break price. There's far less likely to be pullback type activity whereby traders are covering or initiating. There's just not enough room between the extreme and the initial break for this to happen. Understanding that it's really a shift in energy and type of movement that causes a real behavioral change, recognizing when and where these shifts are most likely to happen, and knowing the types of action that are likely to be seen when these shifts are taking place can really help you to capitalize on potentially excellent opportunities. So take the time to consider these underlying principles and gain a better understanding of breakouts.